people looking at their 401ks after another tumultuous week thinking, oh, this is starting to look scary? What would you tell them?
Well, look, my first piece of advice is don't look at your 401k. Just ignore it. But I realize the lure of looking there is hard to resist. And I guess my most important piece of advice is that when you look at it, if the Dow, the S&P is plunging, you should be thinking about only one thing, and that is this a time to buy? Most people immediately think, oh my God, I should have sold, maybe I could get in, is it too late to sell? No, no, no. Selling is not what you should be thinking about, buying. And the same thing, when we have these big surges, the impulse is to think, oh, I better get in there, I better be part of the rally. No, no, no. That's when you think about selling. Now, I wouldn't be selling this stuff because it isn't hitting new highs or anything like that. But in the big declines, yes, it's time to think about buying. And my disciplined approach is ignore the virus, ignore the news, look only at the numbers. And when the market is down 10%, it's time to buy. And then you don't do anything again until it goes down 10% again. Simple, disciplined, by the number, no emotion, no getting caught up in the latest
But doesn't
infection.
it depend how long your time horizon is and how long you have until retirement? I mean, if you're toward the end of that working age, you've seen the financial crisis. That was painful. You don't want to ride something like that out again. I'm not saying that's what this is, but...
Well, I've said this many, many times, every individual investor in the stock market should be long-term. And if you're not long-term, then you shouldn't be in there. If for some reason you have not followed this advice over the years and you need to raise cash, then okay, maybe in some of these rallies you should think about doing it. But I hope there aren't many people like that. If you do not have 10 years of life expectancy, or you don't expect to be around, have the money in for 10 years, then you should not be in a high equity percentage. That's kind of basic investing.
Does the calculus extend to those who are in bonds? I mean, if you're sitting on a huge appreciation in fixed income, is it time to sell?
Well, I don't trade bonds in any sort of sense. To me, bonds are part of a rebalancing strategy and a fixed income. And by the way, I think that's always okay. You don't have to wait for a big move in the market to do that. You can fine tune that. But if your strategy is 70-30, then what you would be doing probably now is buying stocks and selling bonds naturally. So the fact that there has been a coincidental huge rally in the bond market is very beneficial for that. You're going to be selling bonds high and buying stocks low.
Low? We think they are low?
Well, I'm not saying at a bottom. And by the way, forget trying to hit the bottom or know where it's going to be. We have got to live with uncertainty, which is a very uncomfortable feeling, but that's part of life. And of course, we don't know if they're going to go even lower. They very well might, but we just don't know. And that's why if they do go lower, you want to then rebalance or have some money to put more money into the market.
We are coming back here. Dow down 357. I mean, we were down, almost 900 points earlier, these wild swings. On the fixed income question, you have the Fed cutting an emergency 50 basis points. Does that sort of make people go into riskier assets who should not be in risky assets just because yields continue to hit rock bottom?
Well, the theory is, of course, that riskier assets are now going to be priced more attractively in comparison to the low returns on risk-free assets. So that is a corollary. But I think we have to keep in mind here, the Fed has to do what is in the best interest of the country, the economy, from a monetary standpoint. So it's not just thinking about, oh, how is this going to affect individual investors, but it's going to think, is this going to stimulate the economy? Is this going to provide capital at a time when, banks may be pulling in the reins a little bit? I mean, they are looking, I assume, at the big picture. They're not listening to the hectoring from the White House. They're not panicking. They're I believe, I have confidence in them, they're acting in a prudent manner. And however you want to look at it, it's good that they have loosened monetary policy at a time like this.